Hello students, welcome to week 7 of the Accounting Principles course. Be sure to watch this week's devotional and don't forget to read the assigned chapters from the course text. Now listen, we're heading into the last couple of weeks of this course, so no coasting yet, all right? Let's take a look at the week 7's learning objectives. This week, we're taking on some of the financial analysis topics. We'll learn about the concepts and sources of information used in measuring financial performance. We'll also take a look at various analysis techniques like horizontal analysis, trend analysis, vertical analysis, and then some different ratios to financial statements. And we're also going to look at how to apply these different analysis techniques to evaluate a company's financial performance, their financial health, along with understanding the factors impacting management compensation. When analyzing financial statements, managers have to make a judgment call on if a measurement is favorable or unfavorable. So we often use a call it rule of thumb approach. These rule of thumbs are based on experiences, sometimes personal experiences and sometimes industry experiences from other people, and how to measure and rightly judge a particular metric. So applying these rules of thumb when making decisions is a way of using kind of like a lens, if you will, based on experience to assess a particular measurement. So for example, the current ratio is a measure from the balance sheet of the current assets to the current liabilities. You may remember this from Accounting Principles 1. The rule of thumb to assess if a business is healthy is to maintain a 2-to-1 ratio or higher. In other words, twice as many current assets as you have current liabilities. Basically, that means there's at least twice as much cash and cash equivalents to cover any of the debt that you owe over the next 90 days. Now, if you get the ratio above 2-to-1, then you're doing pretty good. If it's below, better stop and take a check and correct your course of action. To gain a better view of the changes in a particular metric over time, analysts use what's called a horizontal analysis. In this type of analysis, a metric is asked over a weekly, monthly, quarterly, or even annually time period about how it's doing. The intent is to look for the ups and downs and then decide if action needs to be taken. So a business might do a horizontal analysis on free cash flow month to month to better understand what's happening and why. Now, for example, during the early days of the COVID pandemic, our business was closely watching free cash flow. We measured it often and regularly, like almost week to week, to make sure we had enough cash to meet obligations. Payroll, unemployment, suppliers reaching out to us for their money. Watching that metric caused us to set up additional lines of credit in case it was needed. Now, somewhat similar to that horizontal analysis is the trend analysis. It's a variation of the horizontal analysis. And it calculates, for example, in this case, calculates percentage changes for several successive years instead of just for 2 years. In this example, the business is watching their operating income at the same time it's watching its net revenues. Now, hopefully, as net revenues increase, the operating revenues tend to track along. Maybe they're down a little bit because you have to factor in expenses and that sort of thing. But anyways, they should be trending up along with net revenues. But not in this case. Take a look in 2008. There was some sort of major expense hit. Something big happened. I'm thinking it was probably the 2008 recession. In fact, I'm pretty sure it was. So a different way to measure a key metric is using what's called a vertical analysis. So a vertical analysis shows how the different components of a financial statement relate to the total amount. So an analyst sets the total figure, say at 100%, and then computes each component's percentage or ownership of that total. So in this example, a pie chart is used to compare where all the net revenue went in 2011 and then what happened in 2010. So you can see in 2011, 44.6% of net revenue went to operating expenses, 42.3% of net revenue went to the cost of sales, and so forth. So that's the vertical analysis. But now look at the same data from a horizontal analysis back up a year to 2010. Operating expenses were paid for by net revenue were slightly up, but the cost of sales was slightly lower. So something happened from 2010 to 2011 to cause operating expenses to decrease as a percent of net revenues, and the cost of sales jumped a little bit. Now, if this were my business, I'd want to know what changed from 2010 to 2011. Those percentage changes are minor, but there could be something lurking just underneath there that you'd want to investigate. When assessing a business's financial health, decision makers should also be looking at profitability and total asset management, another couple of ratios to look at. These metrics provide understanding of the company's ability to earn a satisfactory income, whether the company uses assets in a way to generate revenue. So, and finally, back to the measurement of free cash flow and liquidity. Liquidity is a measurement that provides decision makers with an understanding of a company's ability to pay bills when they're due and to meet unexpected needs for cash. Be sure to read more about the measurement of liquidity and these other measurements in your course text. Okay, that's it for now. Remember to get your discussion questions and quizzes in and assignments in on time as we head into this last couple of weeks of the course. And remember, God is on his throne. He's always been there. He's always going to be. Have a great day.